Welcome to the BOGART Effect, a wealthy wisdom podcast. The following BOGART Effect podcast is intended for general information purposes only. The information discussed is no substitute for personalized investment advice from BOGART or another investment professional. Please see important disclosure information at the end of the presentation. Hey, good afternoon. Welcome to the BOGART Effect. This is James Bogart. I've got Misty with me today, and we're going to be talking about charitable giving. Misty, thanks for joining.
Thanks for having me.
This is our first time in person.
It's my first time in person. Yes, it is.
So normally, Misty's in Texas, and I'm up here in Virginia or the Woodlands. So welcome to the studio. So really going to focus on talking about charitable giving today. This isn't giving money to kids or family or friends. I mean, you can give it to them if you want, but we're really going to be focusing on how do we get tax deductions and tax optimizations off of any money that you're giving away. So a lot of philanthropy, and I think this is a topic that is sometimes a little divisive. Like some people care, some people don't care. But the reality of it is I think it's really important when you're structuring a charitable giving strategy that it needs to align with your values and things that connect with you, resonate with you. And I think a lot of what we experience when we're working with clients is there's just a lot of uneducated individuals around like how to efficiently give. And when I see these numbers, like $500 billion a year of charitable giving, and then you think about like the inefficiency associated with giving strategies, like that's where we're really going to be sitting today and focusing, I'd say primarily a lot of the conversation. So, I think it all starts with having a giving plan. Why don't we dive into that a little bit?
Okay. Yeah. I mean, everybody's giving plan is different, right? So some people have, their life story of what's important to them and why do they give to certain causes or leaving a legacy behind. What are the things that are their money story of what's important to them? Whether it's the why, the institutions, organizations, or just life events that have caused them to give to certain institutions, or again, what they want to leave behind as a legacy. And it's a matter of, figuring out how's the best way to do that to maximize the benefit of that giving.
And I think for me, like, I'll tie it in personally, like I think it's really important to associate the giving that has had an impact on your life. Like a lot of the personal giving I do is back into like our industry, to college programs for financial planning. I do a lot with single mothers and tuition. I think personally, and again, this is James speaking, but like financial literacy is a huge problem we are all dealing with. I think it's the modern era of pandemics. And when you look at how undersaved Americans are, this is one where embracing literacy and investing back into literacy, I think is extremely important. It's a lot of what we do at BOGART Wealth. But, that's our why, my why, right? And and it ties directly into a lot of the giving strategies associated with that. And I also think it's a great opportunity to structure a family strategy. Like I'm now using it as the opportunity to educate my children on philanthropy and why we give, specifically how the gifts that we have an impact on other people and other communities, as an example. I think that all ties into the giving strategy at more of a macro level. And I think back to like, when I first started doing any type of philanthropy myself, it was more for sponsoring different things. And yeah, sure, there's a little bit of call it a business component to it. But now it's like, wow, we can have a real leveraged impact associated with the type of giving. And so one of the things that I think when we talk about a giving strategy, it's how to vet the organizations that you're giving to. To an extent, like I see social pressure happen all the time where it's like, hey, my buddy gave to this, so I need to give to that. I would really encourage individuals, like, don't give because other people, give because it's something that's important to you. So I like to say it aligns with values and making sure it's really, really, really important that like you're connected to whatever the organization is. The other thing that I find too is there's a tremendous amount of inefficiency with a lot of these nonprofits. And so one of the things that I like to do when I'm vetting is like, what is the amount of dollars that I'm giving going to the actual cause itself? So looking at like, what is the operating expense of some of these nonprofits? Not to target any one of them, but like, you look at like United Way, like that, they have a relatively high operating expense associated with that as an organization. Frankly, Red Cross, high operating expense, right? Like, and so when I think about how I'm giving, like I really want my dollars to go to the people that need it, not necessarily to operating an entity associated with a cause that I speak to. So I think that, that all comes into this giving strategy and making sure, again, it's aligning with the objective associated with what you're trying to accomplish. Now, I personally think alignment with a financial plan is like absolutely imperative, especially if it's something where you want to be giving on a frequent basis, right? So we have clients that a lot of times they'll do gifts right at a taxable event. Right. So let's just say they're philanthropically inclined. They usually give, I'll make up the number, $10,000 to $30,000 a year, or they might tithe. We've had a couple of clients together that do a lot of tithing. And so then it becomes, all right, well, that's actually part of your annual expenses if you're doing it on a frequent basis. So then from my lens, it's like, how do we tie this back into an ongoing and sustainable strategy? Why don't we talk a little bit about some of the actual strategies themselves? So, I think first is stock giving, right? Like and by the way, I think the cardinal sin of anybody who has a stock position in a brokerage account that has capital gains, unrealized capital gains, is that they're writing checks. Right? Yeah. Like if there's any takeaway from the podcast today is like, if you have unrealized gains in a stock portfolio in a brokerage account, give away stock. Right?
Yeah. It's not about us as advisors telling people you can't give. It's about saying what's the best way to give so that you can give more. Because if you understand the tax strategies, then your money will go further.
Well, and so like just to put numbers to this, right? Let's say you bought a stock position at $10 and that stock is now worth $100. Well, you have $90 per share of unrealized gains. If you were to write the check, and again, let's just use the same numbers, for $100. In order for us to raise that $100, we actually had to sell probably $120 worth of stock in order to be, actually it's a little more than that, 123.8 worth of stock in order to be able to get you the $100 to give to the charity. Well, charities, 501c3 specifically, do not pay tax. They don't pay tax on capital gains. And so right off the bat, that example, right? So again, you paid 10. You had $90 worth of appreciation, right? To give them 100. Well, if you just gave them one share, that $100 share, they're going to get $100 worth of benefit because they don't pay tax on the capital gains. And let's just say, for example, you have a lot of conviction. You want to still own that position. Well, then I think it makes a lot of sense. Let's say you have $100 worth of cash, give the one share, go buy the share back at $100. You have now increased the cost basis on that new share that you just bought, right? And that makes a ton of sense from a giving perspective. And I think it's also important, like when you talk about a long-term alignment, stock gifts, if you have accounts that have, have brokerage account that have big unrealized gains, always give away the share, right?
Yeah, and most firms have brokerage accounts at all of the large institutions, so they are very able to receive X number of shares when you send them over. So it's something that, I think it's the biggest mistake that a lot of people will make is they'll sell the stock to say, I need to fund, this charity or, fulfill this endowment that I, offered to do over the next couple of years. It's like, let's just send it over to them in kind.
But similar, like I want to emphasize, because you might have conviction in owning that stock, whatever the stock is, and you still want to own it. And so you don't give them the share because you want to still own the stock. I want to place an emphasis of give them the share. And then go buy it back, right? If you're going to give them cash otherwise, ratchet up the cost basis. A couple of things to be cognizant of here. We were talking about this pre-call, but 30%. So look at what your adjusted gross income is as you're doing these stock gifts. So the max outlay on a stock gift is 30% of your adjusted gross income. So again, if your AGI is 300, you can give 90,000, right? And that's the max that you can take on a deduction on an annual basis. Now, that's not to say if you do more, it just carries forward to the next year. That's all you're eligible to deduct on that tax year. If you want to do a cash gift, 60%?
60% for cash.
So you can do up to 60%. So use the same 300, right? So you can do 180,000 of cash. So you do 90,000 of stock, 90,000 of cash, boom, you're done, right? And that'll cover however you want. And you can fully optimize the deduction in that given year. So one of the things that I find really, really impactful, especially when the markets are having a great run, or like we just experienced with the whole Iran conflict, it's like stock prices on an absolute tear for certain industries. Oil, for example, like that might be a great time to go ahead and do a charitable gift, but you might not be ready to actually give it to the charity itself. So this is where we love using donor advised funds. Why don't you talk a little bit about?
Yeah. So you can either, give the gift, if you want to give the gift to them immediately, right? You either give them the cash or the stock options that we talked about, or if you aren't sure who you want to give it to, or you want to space it out over a period of time, you can give cash or the stock that we just talked about into a donor advised fund.
Yeah.
And then once it's in the donor advised fund, they will sell that stock position, and they don't recognize any gains because a donor advised fund is a 501c3 organization. So it is an irrevocable gift once it goes into the donor advised fund. But then you get to decide, how do you want to invest that within that fund, and when you want to give it out and who you want to give it out to.
I like to think of it as a checking account for my charitable giving, right? And it allows me to completely not have to think about the timing of it. Stock market's had a great run, or a particular stock has had a great run. Now's the time. Go ahead and give a stock share. A couple things just to be cognizant of when you're doing stock gifts. In order for the stock gift to be tax deductible, you've had to own that stock position for over 1 year, 366 days. If it's short-term position, unfortunately, they don't allow you to deduct the capital, the appreciation, because it's not long-term yet. So when I think about it, usually these are positions that we've owned for a long, long period of time. It can't just be something I bought, 3 months ago. So like SpaceX, so it had a great run, right? Yeah. Like you can't just go buy share SpaceX this week and then turn around and give it away because it hasn't been a year yet, right? You got to wait a year in order to be able to do a stock gift into a donor advised fund. The other reason I love DAFs is we talked a little bit about that client that likes to do an annual gift. Well, let's just say they had a taxable event in one particular year. They retired and had their non-qualified portion of a pension pay, and all of a sudden they got huge, huge ordinary income in a year. This is an example where maybe we want to go ahead and do some acceleration of charitable giving. So, and again, I'll just keep using the number of $30,000 a year. Let's say you're going to give $30,000 a year, and you're going to happen to have a $1 million taxable event this year. Well, that's a great example where if you have that low cost basis, highly appreciated stock, to go ahead and maybe accelerate a few years worth of those stock donations into something like a donor advised fund. And it now all of a sudden you've got what I like to describe as the checking account. But
yeah. And it's an acceleration of giving, but you're not actually giving it to the institution until you're ready to give it to the institution. Yeah. So it's really great to be able to space that out over a couple of years. Or, if you're just not sure, you are charitably inclined, but you don't know who you want to give it to as well, you can take that as a tax deduction and then plan from there.
Bingo. Yeah. Again, and honestly, these donor advised funds are really, really efficient to use. You have an online web portal where you can just type in and they will mail a check. So I've actually found sometimes for some of these smaller charities that don't happen to have the brokerage accounts, it's a really nice way of just letting it go into for them as in the form of a check. But it also, you can set it up for auto pays, right? So we've got clients where let's just say they do a monthly tithe to their church or make up the, whatever the organization is, where it just automatically auto pays just like it would off of a checking account. I mean, they're fantastic, relatively low from a cost perspective as well.
Sure.
I mean, when you think about setting up charitable buckets, right? Like, so now we can get into some of these others, but like you can do charitable trusts or set up endowments, but I'll tell you firsthand, I've looked at doing these. They are tremendously expensive to set up. And then on an annual basis, all of the tax and legal compliance that goes into them, and I would tell you when it talked about like charitable remainder trusts, charitable lead trusts, CRUTs, there's lots of different ways that you can set up trusts in order to be able to achieve your charitable inclinations, but they do come with administrative costs, administrative burden. So this is where I think it really, really is important coming back to the plan. Let's talk about what your charitable giving inclinations are, how we want to structure it. And frankly, I think of charitable giving in the context of like, if we're trying to establish legacies, that's when endowments and foundations start to make a lot of sense. But if all we're trying to do is let's just say more simplistic tax management work, then I am like the hugest proponent of the
well, and it's great too, because if you give to multiple institutions throughout the year, you have to keep track of who you gave to. And a lot of institutions don't send you receipts or don't send you any kind of tax forms. And so when you have the DAF, Schwab or Fidelity or whoever you're using it with will send you a summary at the end of the year saying all of the total of your gifts. And you just report one line item from a tax standpoint. So it's so much more simplistic and easy and makes life a whole lot more manageable.
I want to emphasize the point you made earlier, though. Anytime we do a charitable gift, it is an irrevocable gift.
Correct.
Right? And that includes into the donor advised fund.
Correct.
I've had instances where people have made gifts in and they're like, wait a minute, I want it back. No, you can't. Like it's an irrevocable gift when we make that gift in there.
Yeah. And it's nice because you can, from a legacy standpoint too, you have the option of when you open these accounts, even though it's an irrevocable gift, you can set it up at the end of your life to either pass it on to your children if you want them to continue to be successful owners, or you could just have institutions that are already on there that you want to get that final gift. So it's still a great way to, again, involve the family in who do you want to give to and continue that legacy if you're putting in large amounts of money.
Well, and I want to pull on that thread a little bit, right? So like, let's just say the legacy piece is important. Like and I'll come back to me and use it as like an example for how we educate our children on giving. Mm-hmm. Mine are too young right now for even thinking about this, but I've had several clients where they are including their kids already. Mm-hmm. And essentially, I keep coming back to this checkbook concept, but like, it's a bucket of money that the family uses to be able to do whatever their charitable inclinations are. And so I've seen families have a lot of success where they have indoctrinated is probably not the right word, but they've included their children in this process, and they actually let the kids help with vetting the charities. Yeah. And again, it's a great way of starting to, just align the values and things that you're ultimately trying to accomplish. Outside of the donor advised fund with stock gifts, the other thing that we have a lot of clients that have big pre-tax retirement accounts, IRA accounts. Mm-hmm. And in a lot of instances, they have required minimum distributions when they turn the age of 73 or 75, dependent upon what year they're born. We have a whole other podcast on that, right? But one of the things that I think a lot of people are let's just say uneducated on, is qualified charitable distributions, which interestingly enough, you can actually do a tax-free distribution from an IRA account starting at the age of 70 and a half.
Correct.
Which is awesome, right? So like if you think about, if you've got these big pre-tax accounts, you can actually distribute an amount on an annual basis for the husband and the wife from one IRA. 111?
111 per person, yes.
So 111 per person per year, right? So $222,000 that we can give away completely tax-free. Now, you don't get a deduction for that, but it is a tax-free distribution that comes out of these IRAs.
Yeah, if you're already charitably inclined and you're going to have really large RMDs, we got a short window potentially from 70 and a half to 73 or 75 to where we can send, checks directly out of the IRA, directly to the institution. There is a caveat that you cannot receive them made payable to you and then forward on, but they made payable to the institution. You can forward that check on, or you can send it directly to the charity. And, it's not reportable as income. I completely
skip that part. Like I would just have it go straight to the charity. Right?
Yes, much easier.
Do not even take the chance. But like part of what we're doing on an ongoing basis for clients is this tax management work. And in a lot of our clients' cases that have these big IRA accounts, the required minimum distributions are onerous. Like they're larger than they probably want. And so I always advocate for any client that's over the age of 70 and a half, let's start doing gifting from the IRA accounts. But once they turn the age of 73 or 75, that charitable distribution can satisfy part of the RMD. So let's just say, and I'll make the numbers up, you've got a $300,000 required amount that has to go out that year. You only want to spend $200,000. Well, theoretically, you could give away another 100, right, and fully satisfy your RMD, right? And now you're in a position where you only spend what you want. You had a tax-free dispersion. Your taxable income gets brought down to the 200 level, but you have fully satisfied the required minimum distribution. By the way, just real quick tangent, why it matters, because if you do not fully satisfy the required minimum distribution amount, there's a relatively heavy penalty. 25% of the amount is imposed as a penalty. So one of the things that we have an ongoing conversation with clients about is utilizing these qualified charitable distributions. QCDs is the acronym that we use a lot of time in order to be able to satisfy part of that required minimum distribution.
And the one caveat is you can't use the DAF at that point. So when you're doing QCDs, they do have to go to the charity.
Thank you.
Even though the DAF is a qualified charity for tax purposes in the future, but once you're of QCD age to qualify directly to the charity.
The QCDs, they don't want it to be, they call it a dynasty, right? Like they don't want the money to go into a charitable account that then you still theoretically have control over disbursement of. They want the money to go to the charities, which okay, fine, fundamentally. A lot of people ask why the different ages, like 70 and a half, 73, 75. The reality is the laws keep changing, right?
Yeah.
So the 70 and a half number actually used to be the required minimum distribution age. I think that was like 6-7 years ago.
Yeah, it was a long time. And it just never changed.
It never changed.
As they changed the RMD ages.
Well, and the thing that was always so frustrating about this was up until the first Secure Act, 2019, we actually didn't know the annual QCD amount usually until December, right? So it made planning for this so difficult. Now we have clarity. It's 111,000 for 2026. You see where my head's at. But that's indexed up. So last year was 108. I think the year before that was 105. I anticipate that it'll continue to escalate with cost of living adjustments on an annual basis. But the reality of it is we at least know that there is an amount that we can plan for, that if you are charitably inclined and we have these big IRA accounts and this is a problem that we need to be managing for, it's a great way of doing it.
And again, part of that comes back to the initial planning. When we start talking with people and figuring out what their giving plan is throughout retirement, is figuring out, what do we do today if we want to give today? What do we do once we reach a QCD, once we reach a RMD age, and really kind of making sure that we're using all the tax strategies to your advantage and not missing something.
There you go. And again, not to emphasize, like we're obviously spending a ton of time talking about donor advised funds and these qualified charitable distributions. There are lots and lots and lots of different ways of doing charitable giving. And this is where I think the integration of a financial plan, in addition to a tax strategy, is extremely important. We will help you go through the different options of, a charitable remainder trust, a charitable, a CRAT. So what is that? Charitable remainder unit trust, a charitable remainder annuity trust. And then we can talk about private foundations. We can talk about endowments. There are pros and cons to every single one of these charitable strategies. And I think the reality of it is it comes back with the alignment of what is your values? What are we trying to accomplish? And how does it fit into an overall tax strategy, but also an overall estate strategy, and making sure that's all very, very seamlessly integrated. Let's talk about some of the mistakes. I know we've already hit on some of them, but I want to make sure we highlight some of the common mistakes that we see. I already emphasized giving cash.
Right.
Like if there's any takeaway from this podcast, it's if you have cash, if you have highly appreciated stock, do not give cash. Give the stock and then buy the position back, right?
Right. If you just have cash and that's it, that's all you have, great. But if you have more of a complex portfolio, it's definitely something to make sure you talk to your advisor to figure out what's the right strategy to give cash if that's the best way.
Which the other thing, I already mentioned it, but again, I want to emphasize the 1-year rule on stock positions. That's another one that trips people up a lot of times. So make sure you own the position for over a year. All of these these charitable givings are calendar year. Right. So, and especially if we're giving stock, I highly, highly recommend before December 15th, like there is an operational period of time that is required on doing these gifts, signing off forms, making sure there's receipt, all the different things. Like it has to be done within a calendar year.
At end of the year, it gets busy for everybody else doing the same thing. And so financial institutions get busy when you're trying to do these transfers or open these accounts to get them to. So it is something, and hopefully we know that, right? Like as we're working together, we know what your plan is. So we know as the year's coming to an end, we're, trying to button it up.
I tell you, the ones that always get complicated are the qualified charitable distributions. Like especially when we have a client that is now taking required minimum distributions, we know that they're going to do it. I strongly prefer, as best we can, like October to get these things done, recognizing that's not always possible and who you want to give to might change between then and the end of the year. But even then, it still requires time in order to be able to do it. And by the way, if we're giving out of an IRA account, we have to raise cash, right? So like there's a transactional period of time that we have to be able to integrate that into the process. And
part of that mistake will be too is like, let's say you've already satisfied your required minimum distribution for the year and you decide that you want to give to charity. You don't get to use that QCD to offset your RMD. You still have that full distribution that you took. And now the remainder of that is going to be tax-free as a QCD, but it's not going to negate anything you did. So there is, again, some year-end timing of if you're of RMD age, how do I manage this QCD through the year to make sure I hit it right?
And I like to have the conversation throughout the year. And if possible, we do at least a portion of the gift for that exact reason earlier on in the year, whatever, let's just say mid-year, second quarter, third quarter. And then we can always true it up at the end of the year.
Correct.
Right. Like, and I do have, we have clients that like, they'll wait to see how their performance was for the year. And like, they'll wait and make sure they're optimizing right at the end of the year. Another one that I've seen a lot is forgetting state tax implications on any of the charitable gifts. Not every state is the same, right? So making sure if you are in a income tax state that we're integrating the thresholds for the state for whatever the deductibility is off of those donations is being considered, because there are some that completely disallow some of the charitable giving, and making sure we're integrating that. So, I'm not one to ever like highly encourage too little or too much, but we have seen instances where people have gotten, let's just say, overzealous on charitable giving, and that has had long-term implications on their financial plans. It's important to emphasize, I think alignment of values relative to someone's portfolio size is extremely important. One of the things that I find is the internal, let's just say feeling of obligation to give, but not necessarily keeping a lens of what that does to long-term financial viability. So making sure that we don't overgive, right? And especially when we talked about that example of you have the taxable event for that year, and then all of a sudden we do a huge gift that 1 year just to bring the taxable event down, but then that does actually undermine long-term solvency. Let's make sure that we're integrating giving strategies on an annual basis and making sure we're looking at the longer-term financial plan associated with that.
And part of that is to your point that you said earlier, as far as looking at the end of the year, evaluating your portfolio to find out what was the success of your portfolio this year, right? Did you have higher than expected earnings in the market? Did you overspend this year? What did it look like to say, how much can I give that's viable without hurting my overall financial plan?
And the one that I see a lot of times is tithing, right? How do we structure tithing relative to portfolio performance, income for the year? And again, I think that this is important to establish the governance, whatever it is. Obviously, while you're working, it's very easy from a tithing perspective, right? We've got a W-2, boom, done. But when it comes to your portfolio performance, are we giving unrealized gains on an annual basis? I've seen that get people into trouble because, oh, by the way, those gains can be completely gone the next year, right? I think just establish governance. I have my personal opinion on this. I think it should be the income that a portfolio generates, and that should be what we tithe off of, or what your distribution level is off of your retirement accounts. Fully aligned on that, because you didn't pay tax on the way in for retirement accounts. But the reality of it is whatever that protocol is, keep with it. Have that be part of the financial plan that's integrated in on an ongoing basis. And
we're just here to tell you if there's little errors and different things of the impact of doing certain things. Again, it's your money. You get to make those decisions. We just want you to be educated on the different strategies that you're using and how much you might be giving.
And I think this is where part of what we're talking about is viability, but part of what we're talking about is optimization and efficiency. A lot of what we've spent time focusing on today is around what is the most tax efficient and optimized way of doing the gift, not necessarily, should you do it or should you not do it. The strategy itself matters. I think really getting into this on an ongoing and consistent basis, making sure that we're aligning viability with the optimization, with ultimately long-term plan. I think that's really what the lens is we have here. And I think partly in parting, one of the things that I like to always tell people is you don't have to be ultra wealthy to give away money, right? Every dollar has an impact if it's given correctly. And I think making sure that we're doing the vetting of the appropriate charities and that it's aligning with what your long-term goals and objectives are, I think that's paramount when it comes to any long-term charitable giving strategy.
Yeah. If outside of your small, your churches and your local things like that, if you're giving to large institutions or even, public institutions that are still a 501c3, you can visit their websites and they have all of that information on there. So if you really are trying to vet an institution to find out, what the impact of your money is going to, you can find that information very easily out there if that's important to you.
Well, and a lot of times, I give to the charities I participate in as well, right? So it's I think about locally here in Northern Virginia, I was very involved with Food for Others as an example, and I was on the board for several years. So giving there is an important part of what we do on an ongoing basis.
Right.
I obviously know that's what the operating
You saw the impact on a day-to-day basis.
Well, I saw the impact, but I also know how much of that dollar is actually going to the cause itself. And that spoke to me personally. And of course, it's one that I think on an ongoing basis will continue to speak to us, and it has a direct impact on the community. And that's one of many things. I think comes back to align your giving with your values, what means something to you. I love using it as an opportunity to educate your children or grandchildren, right? Make it part of the family legacy conversation. Yeah. Misty, thanks for the time today.
Thanks for having me. I enjoyed it.
It was awesome.
Thanks.
Thank you. The previous presentation by Bogart Wealth was intended for general information purposes only. No portion of the presentation serves as the receipt of or as a substitute for personalized investment advice from Bogart Wealth or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy or any other non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation, or prove successful. Neither Bogart Wealth's investment advisor registration status nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Bogart Wealth is neither a law firm nor accounting firm, and no portion of its services shall be construed as legal or accounting advice. No portion of the podcast content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Copies of Bogart Wealth's current written disclosure brochure and Form CRS discussing our advisory services and fees are available upon request or at www.bogartwealth.com.